The 400 wealthiest Americans paid an effective tax rate of 23.8% between 2018 and 2020. The average American paid 30.2%. This gap is by design, not by accident. You think you are in a tax bracket. You are at a tax level. Your level depends less on what you earn and more on how you earn it. The highest marginal rate in America is not 37%. It falls closer to 40%. And it lands on a single mother working overtime at a $40,000 job. 7 levels, 1 tax code. Think of it as a highway with 7 toll booths. 1 pays you. 1 has an express lane only certain vehicles can use. Start where the toll runs backward. Level 0 negative rate zone. At this level, tax season pays you. Your effective rate runs negative. The refund arrives larger than the tax withheld because the earned income credit and child tax credit do the work of a second paycheck. You file in February and wait. The IRS holds refunds with these credits until mid-February under the PATH Act. So the largest financial event of your year arrives on someone else's calendar. The fear here lives at the cliff edge, not in the tax owed. $1 of investment income above $11,950 in 2025 wipes the entire earned income credit out. The drop is vertical, not gradual. The mistake is taking cash work off the books. Cash income that does not count as earned income disqualifies you from the credit you need most. The maximum earned income credit in 2025 reaches $8,046 for a family with 3 children. According to the IRS, the average household received about $2,916 in 2024. The hidden cost is cliff anxiety. Every overtime hour, every side gig, runs through a calculation in your head. One wrong move erases $8,000. And the math on that overtime hour is where the structure reveals itself. The earned income credit phases out at 21% for 2 children. Add FICA, add the federal bracket. Your marginal rate on the next hour worked sits closer to 40% than to the 12 you think you are in. What changes when there is no booth paying you anymore? Level 1. Payroll-Only zone. At this level, you do not check your tax bill. You check your pay stub. And the line you actually feel is not the one labeled federal income tax. It is FICA. Your effective federal income tax rate is small. The standard deduction eats most of it. But FICA takes 7.65% off the first dollar and the 10,000th dollar with no discrimination. You feel a flat tax pretending to be a payroll deduction. The behavior here is pay stub literacy without tax literacy. You read the FICA line first because it is the one that hurts. The fear is reclassification being moved from W-2 to 1099. Which doubles the FICA burden to the full 15.3% self-employment rate with no employer match. The mistake is skipping the 401k employer match, the only truly tax-free dollar this level has access to. Social Security tax applies to wages up to $184,500 in 2026 per OSPALIC, the Social Security Administration. Medicare has no wage cap. Combined FICA stays at 15.3%, split evenly between you and your employer. The hidden cost is FICA regressivity. Federal income tax is progressive. FICA is flat. Most of your effective rate at this level is the flat tax. The tax that hurts you most is the one written to be invisible. Then the standard deduction stops being the whole story. Level 2 standard deduction zone. At this level, you owe federal income tax. Not a lot. Enough to make tax season feel real, not enough to make it feel like strategy. The 2025 standard deduction sits at $15,750 for single filers and $31,500 for married filing jointly after the One Big Beautiful Bill Act. That deduction absorbs most of the 10 and 12% brackets before the 22% bracket touches you. The behavior is auto-filing. TurboTax free tier, a small refund. The fear is a side gig pushing AGI just high enough to clip a phase-out credit. The saver's credit, the premium tax credit on ACA coverage. The mistake is the most common mistake in the entire tax code, confusing 22% marginal with 22% effective. and making financial decisions based on a number that does not describe your life. The average effective federal income tax rate for all Americans in 2022 was 14.5%, per IRS statistics of income. The bottom 50% of taxpayers paid 3.7%. The hidden cost is tax blindness. The standard deduction is good enough to remove your incentive to learn the tax code. That comfort lasts 20 years. You arrive at level 3 having never asked about Roth conversions, SA triple tax treatment or backdoor strategies, because nothing at level 2 forced the question. The loud number on your bracket is 22. The quiet number on your effective rate is 13. The 9-point gap is the room the code gives you to learn. Most never enter it. The gap closes fast above 200,000. That is where the second tax code starts. Level 3, upper middle squeeze. At this level, you stop filing taxes and start planning them. Quarterly. The CPA's number sits in your phone. Your effective rate climbs to 18 to 22%. The federal marginal bracket touches 24 or 32. But the real change is what gets added on top. A 0.9% additional Medicare tax and a 3.8% net investment income tax. Both triggered above $200,000 for single filers, $250,000 for married joint. You max the 401k at $23,500 in 2025. You open an HSA. You watch Maggie like a hawk through Q4 because a year-end bonus can push you across the threshold and trigger surtaxes you did not budget for. The mistake nobody warns you about is structural. Those two thresholds, 200,000 and 250,000, have not moved since 2013. They were never indexed for inflation. The NIIT raised $59.8 billion in 2021, and the number of taxpayers hit by it more than doubled in 8 years. Per a Congressional Research Service report, no vote raised your taxes. The line just stayed still while your salary did not. The hidden cost is stealth bracket creep, and here is the move most people miss. Level 3 is not a transition point. It is a destination. People spend a decade optimizing to reach level 4, and discover level 4 adds 6 percentage points of effective rate in exchange for more hours, more CPA fees, more AMT anxiety. The meaningful jump skips level 4 entirely. It goes from level 3 to level 6 from wages to ownership. These are two different axes, not two rungs of the same ladder. But most people take the obvious path first. They keep climbing the wage axis. Welcome to the Plateau. Level 4, High Earner W2 Plateau. At this level, you are a high earner by every demographic measure, and a small player by every tax planning measure. The cheap optimization moves run out at this level. Your effective rate sits at 28 to 32%. The 37% federal bracket starts at $626,350 of taxable income for single filers in 2025. Per the IRS, at a high state, California's top rate is 13.3%, and the NIIT 3.8% on investment income. The combined marginal rate on your last dollar passes 50. You run mega backdoor Roths. You defer compensation when the employer plan allows. You buy rental real estate for depreciation. You have a CPA on retainer, not a CPA on call. The top 1% of Americans paid an average effective federal income tax rate of 26.1% in 2022, per IRS data. Treasury analysis puts the top 1%'s combined federal income and payroll rate near 30%, and the curve barely climbs higher than that for the 0.1 and 0.01%. The fear is the math on the next raise. After federal, state payroll, and surtax, the take-home on the marginal 100,000 can land below 50. The hidden cost is time tax. Every financial decision requires modeling. A home purchase becomes a CPA call. A bonus negotiation becomes a scenario spreadsheet. You do not pay more in money, you pay more in hours. Some people at this level get a different paycheck. Half wages, half stock. Those halves get taxed as if they came from different countries. Level 5, equity compensation layer. At this level, half your income arrives as a number on a pay stub. The other half arrives as a number on a vesting schedule. The wage portion gets taxed like level 4. The equity portion routes through a different system entirely. Restricted stock units count as ordinary income at vest. Incentive stock options trigger alternative minimum tax exposure at exercise. Qualified small business stock under Section 1202 can exclude up to $10 million of gain, a feature most W-2 workers never hear about. Your effective rate often drops to 22 to 26%. Because long-term capital gains are taxed at 15 or 20% versus 37 on wages. The behavior is exercise modeling 83B elections at Grant AMT pre-calculations before year-end. The fear is the AMT clawback, exercising ISOs in March and watching the stock fall through October. While owing tax on phantom gains, the market already erased. The mistake is selling vested RSUs the day they hit without strategy, missing the 0% long-term capital gains bracket that applies below $48,350 of taxable income. For single filers in 2025, the hidden cost is the AMT phantom. You can pay tax this year on a gain that disappears next March. Wages cannot do this. Equity can. The tax code stays silent on the asymmetry. And once you hold the equity long enough, you stop being a worker who owns stock. You become an owner who happens to work. Level 6, Capital Class Floor. At this level, you receive K-1 forms in March, not W-2s in January. Your income does not come from a job. Your income comes from a structure. The effective rate runs 18 to 24%. Income flows through long-term capital gains at 15 or 20%. Qualified dividends at the same rates pass through entities with the 20% qualified business income deduction, made permanent under OBBBA in 2025. Real estate offers depreciation. 1,031 exchanges defer gains indefinitely. Opportunity zones offer further deferral. The behavior is structural. You hold assets through S corporations and limited partnerships. You think in entities, not paychecks. The fear is the 3.8% NIIT on passive investment income, which cannot be optimized away through retirement contributions. The mistake is misclassifying active versus passive participation. Material participation rules are strict, and getting them wrong either kills the QBI deduction or triggers NIIT on income you thought was exempt. The qualified business income deduction phase-in begins at $197,300 for single filers in 2025. Per Tax Foundation analysis, the hidden cost is identity tax. You stop being a worker who saves. You become an allocator. Friends from Level 2 do not understand when you say a K-1 is late instead of a paycheck. Some relationships do not survive the translation. Income type matters more than income amount here. Wages happen to be the costly type, and one level above this, even realization becomes optional. Level 7, Wealth without realization. At this level, you do not have a tax rate. You have a tax strategy with no realization event. The buy, borrow, die strategy is the architecture. Hold appreciating assets. Borrow against them through margin loans rather than selling. Pass them at death, where the step up in basis erases the embedded capital gains entirely. The wealth grew. The tax never triggered. The top 400 wealthiest Americans reported an effective federal income tax rate of 23.8% between 2018 and 2020, per UC Berkeley NBER research published in 2025. That number describes what they reported. A separate ProPublica analysis of the 25 richest Americans from 2014 to 2018 calculated a true tax rate of 3.4%. Measured against $401 billion of wealth growth, including unrealized gains. Both numbers are accurate. They describe the same people. They measure different things. The Forbes 400 average AGI sits near $173 million. Average wealth runs near $8 billion. The gap between income and wealth at this level makes the income tax close to optional. The fear is policy change, mark-to-market proposals, billionaire minimum tax floors, estate exemption cliffs. The strategy works only as long as current tax law remains in place. The hidden cost is political risk premium. Calling this wealth misses the point. What you hold is an option on wealth, conditional on the law not changing. Every election cycle prices that option higher. 7 booths, 1 highway. The question is not which booth you sit at. The opening number, 23.8% versus 30.2%, tells a story about direction, not unfairness. Every level has a hidden cost. Every level has tools. The architecture has shape, but the shape is neither flat nor a ladder. 3 moves this week. Pull last year's 1,040. Divide total tax by AGI. Compare that effective rate to the marginal bracket you tell people you are in. Check the FICA line on your last pay stub and add it to that effective rate. That is your real tax level. Then ask the real question. Are you optimizing within your current level, or are you moving to a different axis? On next month's pay stub, which line will you look at? First gross federal income tax or net? The answer reveals which level you actually live at, regardless of what your salary says. You do not choose your tax rate. You choose your level, and the level chooses what the rest of your life feels like.